SoFi surged to a record $30.35, topping its 2021 high, a milestone that turned heads and relit the fintech comeback narrative. Investors are hyped heading into Q3 earnings, but the ride got choppy. In the final 2 weeks of September, the stock retraced more than 16%, sliding back toward $25 and briefly breaking below the 20-day simple moving average that had been propping up its uptrend since April. Meanwhile, institution-level voting with dollars continued. CMG Global Holdings boosted its SoFi stake by 51.7% in Q2. Management now guides FI 2025 to 31 cents GAAP EPS, while Wall Street sell-side consensus sits a touch lower at about 26 cents for the current fiscal year. Why $30.35 matters, and why peaks are emotional. Stocks love round numbers and emotional milestones. Breaking your 2021 peak is the financial equivalent of stepping into your high school reunion and realizing your old rival now has fewer followers than you. For SoFi, hitting $30.35 did two things at once. It delivered a headline, new all-time high, and validated a multi-quarter story of rising members, better unit economics, and upgraded guidance. Market psychology is powerful. When a name tears past a past high, momentum traders pile in, algos get excited, and narrative-hungry investors start asking what if, which can amplify moves. Imagine SoFi as a long, slow-brewing espresso machine. For months, it's been steaming, improving revenues, adding members, and nudging profitability. Hitting $30.35 is the first time someone clapped because the crema looked perfect. Suddenly, everybody wants a sip. Q3 expectations. Why investors are upbeat. Investors are specifically excited about Q3 for a few concrete reasons. First, recent quarters showed the company scaling fast, record member growth, rising deposit inflows, and stronger lending originations, and management has been raising guidance off the strength of those trends. Second, SoFi has been showing not just top-line growth, but also improving margins and GAAP profitability, which in fintech land is like a unicorn finally showing its teeth. Anticipation for Q3 is therefore less faith and more, we've seen the engine rev, and if Q3 confirms the momentum, the logic for higher prices becomes straightforward. Think of investors as stadium fans waiting for the band's big chorus. Q2 had a killer bridge. Q3 is the chorus everyone paid for. If the chorus slaps, the crowd roars, and the stock dances. If the chorus misses, people start walking out mid-song. By the way, if you are benefiting from the content so far and want more like this, hit the subscribe button, turn on the notifications bell, and comment the word more. Just go ahead and type the word more so I know. Now that you've commented, let's continue. But also, we humbly request you to support us by becoming a member of our channel, where we share exclusive member-only videos and stock news and opportunities. Find the link in the video description section below. The profit-taking pullback, normal market housekeeping. Markets never move in a straight line. The final 2 weeks of September saw more than a 16% pullback, a classic take profits event after an intense run. Traders who'd ridden earlier rallies often sell into strength to lock gains. Newer money sometimes reprices risk at higher volatility, and technical traders watch moving averages for traction. The retreat to roughly $25 and the breach of the 20-day simple moving average, SMA, were technical red flags for short-term momentum players, and that alone can spark a bit of a scramble as stop losses trigger and short-term sellers push price lower. If the rally is a wave, profit-taking is the tide. Surfers, momentum traders, ride the swell up, then someone pulls out, and the small ripples rearrange everyone's balance. The 20-day SMA is the shoreline. When the water recedes past it, some surfers think the good waves are gone, until the next set arrives. Institutional interest, the CMG signal. Retail chatter is entertaining, but institutions move real money. CMG Global Holdings' decision to increase SoFi holdings by 51.7% in Q2 is the kind of institutional activity that investors watch closely. When an allocator adds that much, it signals confidence in management strategy and the underlying unit economics, or at least a willingness to take a larger bet on the story. Institutional buying can provide a base of supply that stabilizes shares during mini sell-offs and also signals that pros are following the narrative. Illustration: if investors are villagers, institutions are the caravan merchants. When a caravan rolls into town and buys up the entire spice rack, everyone notices, and some villagers decide to trade their chickens for a slice of the action.